Hey everyone, and welcome to the channel. If you're watching this, you're probably thinking about investing, maybe feeling a little overwhelmed, and wondering where to even begin. Don't worry, you're in the right place. Investing can seem intimidating, like it's only for Wall Street experts or people with tons of money. But the truth is, investing is for everyone. It's the single best way to build wealth over the long term, and it's never too late or too early to start. In this video, we're going to break down the fundamentals of investing, walk you through the essential steps to get started, and equip you with the knowledge and confidence to make informed decisions. We'll cover everything from understanding different investment options to building a diversified portfolio. So, grab a pen and paper, or open your favorite note-taking app, and let's dive in. But wait before that. If you haven't subscribed to the channel yet, please do so as well. Together, you can help us reach 5,000 subscribers. I can count on your support. If you've already subscribed, please leave a comment stating that you have done so. Thank you. Now that you have, let's move on. 1. Why investing matters. Before we get into the how, let's talk about the why. Why is investing so important? The simple answer is to build wealth and secure your financial future. Here's why investing should be a priority. Beating inflation. Inflation is the silent wealth killer. It's the rate at which the price of goods and services increases over time. If your money is just sitting in a savings account earning a low interest rate, it's actually losing purchasing power. Investing, on the other hand, can potentially generate returns that outpace inflation, allowing your money to grow in real terms. Compounding interest. This is the magic ingredient. Compounding is when you earn returns not only on your initial investment, but also on the accumulated interest or profits. It's like a snowball rolling downhill. It gets bigger and faster over time. Achieving financial goals. Whether you dream of buying a house, retiring early, funding your children's education, or simply having financial security, investing can help you reach those goals. It provides the means to accumulate the necessary funds. Building long-term wealth. Investing is a long-term game. While there can be short-term ups and downs, the historical trend shows that the market goes up over time. Consistent investing, even small amounts, can lead to significant wealth accumulation over decades. Think of investing as planting a seed. It takes time to grow, but with proper care and patience, it can blossom into something substantial. Leaving your money under the mattress isn't going to cut it. 2. Understanding risk and reward. One of the most fundamental concepts in investing is the relationship between risk and reward. Generally, the higher the potential reward, the higher the risk. It's a balancing act. Let's break this down. Risk, the possibility of losing some or all of your investment. Risk can come in many forms, such as market volatility, company-specific problems, or economic downturns. Reward, the potential return on your investment. This could be in the form of capital appreciation, an increase in the value of the asset, dividends, payments made by companies to their shareholders, or interest. Different investments carry different levels of risk. Low risk generally includes savings accounts, certificates of deposit CDs, and government bonds. These offer lower potential returns, but are considered relatively safe. Medium risk includes corporate bonds, real estate, and balanced mutual funds. These offer potentially higher returns than low-risk investments, but also come with greater volatility. High risk includes stocks, particularly individual stocks, cryptocurrency, and venture capital. These have the potential for significant returns, but also carry a high risk of loss. It's crucial to understand your own risk tolerance, which is your ability and willingness to withstand potential losses. Your risk tolerance depends on factors like your age, financial situation, investment goals, and comfort level with uncertainty. Are you a conservative investor who prefers to minimize risk, even if it means lower returns? Or are you an aggressive investor who is willing to take on more risk for the potential of higher gains? There are online risk assessment questionnaires that can help you gauge your risk tolerance. Take some time to understand yourself. Don't put all your eggs in one basket. Diversification, which we'll cover later, is a key strategy to manage risk. 3. Investment options explained. Now, let's explore the most common investment options available to beginners. Stocks. Stocks represent ownership in a company. When you buy a stock, you become a shareholder and have a claim on a portion of the company's assets and earnings. Stocks are generally considered a higher risk, higher reward investment. There are two main types of stocks. Common stock gives you voting rights in the company and the potential to receive dividends. Preferred stock typically doesn't have voting rights but offers a fixed dividend payment. You can buy individual stocks, but it's generally recommended for beginners to start with stock mutual funds or ETFs, which provide instant diversification. Bonds. Bonds are essentially loans you make to a company or government. In return for your loan, you receive interest payments over a set period, and the principal is repaid at the end of the term maturity date. Bonds are generally considered lower risk than stocks. There are different types of bonds. Government bonds, issued by national governments, e.g., U.S. Treasury bonds. Considered very safe. Corporate bonds, issued by companies, offer higher yields than government bonds, but also carry more risk. Municipal bonds, issued by state and local governments. Interest income is often tax-exempt. You can buy individual bonds, but bond funds are a more convenient and diversified option for most investors. Mutual funds. Mutual funds pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other assets. Professional fund managers make the investment decisions. Mutual funds are a great way to achieve diversification without having to pick individual securities. There are many different types of mutual funds. Stock funds invest primarily in stocks. Bond funds invest primarily in bonds. Balanced funds invest in a mix of stocks and bond. Index funds track a specific market index, such as the S&P 500, offer low costs and broad market exposure. Target date funds automatically adjust their asset allocation, the mix of stocks and bonds, over time to become more conservative as you approach your retirement date. A great option for hands-off retirement planning. Mutual funds typically charge an expense ratio, which is a percentage of your assets that is used to cover the fund's operating expenses. Pay attention to expense ratios, as they can eat into your returns over time. Exchange-traded funds, ETFs, are similar to mutual funds, but they trade on stock exchanges like individual stocks. They offer diversification, low costs, and tax efficiency. ETFs are another excellent option for beginners. Like mutual funds, there are ETFs that track various market indexes, sectors, and asset classes. Some popular ETF examples include SPY, tracks the S&P 500. QQQ, tracks the NASDAQ 100. AGG, tracks the U.S. Aggregate Bond Index. Real estate. Investing in real estate can involve purchasing properties directly, e.g., rental properties, houses to flip, or investing in real estate investment trusts, REITs. Real estate can provide income, appreciation, and diversification. REITs are companies that own and manage income-producing real estate. They allow you to invest in real estate without having to directly own or manage properties. Cryptocurrency. Cryptocurrency is a digital or virtual currency that uses cryptography for security. Examples include Bitcoin, Ethereum, and Litecoin. Cryptocurrency is a highly volatile and speculative investment. While there is potential for high returns, cryptocurrency is also very risky and not recommended for beginners until they have a solid understanding of the market and a high risk tolerance. Proceed with extreme caution. 4. Getting started. Opening a brokerage account. Okay, now that you have a basic understanding of investment options, let's talk about how to actually start investing. The first step is to open a brokerage account. A brokerage account is an account you use to buy and sell investments like stocks, bonds, mutual funds, and ETFs. Here's what you need to do. Research and choose a brokerage. There are many online brokerages to choose from, each with its own pros and cons. Some popular options include Fidelity, a well-established brokerage with a wide range of investment options and excellent customer service. Charles Schwab, another reputable brokerage offering a comprehensive suite of services and low fees. Vanguard, known for its low-cost index funds and ETFs. TD Ameritrade, now part of Charles Schwab, offers advanced trading platforms and tools. Robinhood, a popular app-based brokerage known for its commission-free trading. Consider these factors when choosing a brokerage. Fees and commissions. Some brokerages offer commission-free trading, while others charge a fee per trade. Investment options. Make sure the brokerage offers the investment options you are interested in. Research tools. Look for brokerages that provide research reports, market analysis, and other tools to help you make informed decisions. Educational resources. Choose a brokerage that offers educational materials, such as articles, videos, and webinars, to help you learn about investing. Customer service. Read reviews and make sure the brokerage has a good reputation for customer service. Complete the application. Once you've chosen a brokerage, you'll need to complete an online application. You'll typically need to provide personal information, your name, address, date of birth, social security number, or tax ID. Employment information, your employer and occupation. Financial information, your income, net worth, and investment experience. Investment objectives, your goals for investing, e.g., retirement, saving for a house. 2. Fund your account. After your application is approved, you'll need to fund your account. You can typically do this by electronic bank transfer, transferring money from your bank account to your brokerage account. Check, mailing a check to the brokerage. Wire transfer, transferring money electronically from your bank to the brokerage. Start investing. Once your account is funded, you're ready to start buying and selling investments. Don't be intimidated by the application process. Brokerages are there to help. Many offer live chat or phone support if you have any questions. 5. Building a diversified portfolio. Diversification is a crucial risk management strategy. It involves spreading your investments across different asset classes, sectors, and geographic regions to reduce the impact of any single investment on your overall portfolio. Think of it this way. Don't put all your eggs in one basket. Here's why diversification is so important. Reduces risk. By diversifying, you reduce the risk of losing a significant portion of your investment if one asset performs poorly. Smooths returns. Diversification can help to smooth out the volatility of your portfolio, leading to more consistent returns over time. Captures opportunities. By investing in a variety of assets, you increase your chances of capturing opportunities in different market segments. How to build a diversified portfolio. 1. Asset allocation. Determine the appropriate mix of stocks, bonds, and other assets based on your risk tolerance, investment goals, and time horizon. Conservative. Primarily bonds, with a smaller allocation to stocks. Suitable for investors with a low risk tolerance and a short time horizon. Moderate. A mix of stocks and bonds. Suitable for investors with a moderate risk tolerance and a medium time horizon. Aggressive, primarily stocks, with a smaller allocation to bonds. Suitable for investors with a high risk tolerance and a long time horizon. 2. Sector diversification. Within each asset class, diversify across different sectors of the economy. For example, in stocks, you could invest in technology, healthcare, consumer staples, and energy. 3. Geographic diversification. Invest in both domestic and international markets. This helps to protect your portfolio from economic downturns in any single country. 4. Rebalancing. Periodically rebalance your portfolio to maintain your desired asset allocation. This involves selling assets that have performed well and buying assets that have performed poorly. A simple way to achieve diversification is to invest in diversified mutual funds or ETFs that track broad market indexes. 6. The importance of long-term investing. Investing is a marathon, not a sprint. It's crucial to have a long-term perspective and resist the urge to make impulsive decisions based on short-term market fluctuations. Here's why long-term investing is so important. Compounding. The power of compounding works best over long periods. The longer your money is invested, the more time it has to grow exponentially. Market cycles. The stock market goes through cycles of ups and downs. Trying to time the market is extremely difficult, even for professionals. Long-term investors can ride out the volatility and benefit from the overall upward trend of the market over time. Reduces risk. Over the long term, the risk of investing in stocks decreases. Short-term market fluctuations become less significant as your investment horizon extends. Warren Buffett, one of the most successful investors of all time, famously said, "Our favorite holding period is forever." Avoid emotional investing. Don't panic sell when the market goes down, and don't chase after hot stocks. Stick to your long-term investment plan. 7. Dollar cost averaging. Dollar cost averaging (DCA) is a simple and effective investment strategy that involves investing a fixed amount of money at regular intervals, regardless of the market price. Here's how it works. You decide on a fixed amount to invest, e.g., $100 per month. You invest that amount at regular intervals, e.g. monthly, regardless of whether the market is up or down. Here's why dollar cost averaging is beneficial. Reduces risk. DCA helps to reduce the risk of investing a large sum of money at the wrong time. Removes emotion. DCA takes the emotion out of investing by automating the process. Potentially lower average cost. Over time, DCA can potentially lead to a lower average cost per share, as you buy more shares when prices are low and fewer shares when prices are high. Dollar cost averaging is particularly useful for beginners who are new to investing and may be nervous about market volatility. 8. The importance of reinvesting dividends. Reinvesting dividends is another powerful strategy to boost your long-term returns. Dividends are payments made by companies to their shareholders out of their profits. When you reinvest dividends, you use those payments to purchase more shares of the company. Here's why reinvesting dividends is so beneficial. Compounding. Reinvesting dividends allows you to earn returns not only on your initial investment, but also on the dividends you reinvest. This accelerates the power of compounding. Increased ownership. Reinvesting dividends increases your ownership stake in the company over time. Higher long-term returns. Studies have shown that reinvesting dividends can significantly increase your long-term returns. Most brokerages offer the option to automatically reinvest dividends. Make sure to enable this option in your account settings. 9. Common investing mistakes to avoid. Investing can be rewarding, but it's also easy to make mistakes. Here are some common investing mistakes to avoid. Common investing mistakes. Not doing your research. Don't invest in something you don't understand. Take the time to research different investment options and understand the risks involved. Chasing hot stocks. Avoid chasing after stocks that are trending upwards, as they may be overvalued and due for a correction. Trying to time the market. Trying to predict the market is extremely difficult and often leads to poor investment decisions. Investing based on emotion. Don't let fear or greed drive your investment decisions. Stick to your long-term investment plan. Not diversifying. Putting all your eggs in one basket can be risky. Diversify your portfolio across different asset classes, sectors, and geographic regions. Ignoring fees. Pay attention to fees and expenses, as they can eat into your returns over time. Not rebalancing. Periodically rebalance your portfolio to maintain your desired asset allocation. Ignoring taxes. Be aware of the tax implications of your investment decisions. Procrastinating. The sooner you start investing, the more time your money has to grow. Don't put it off. Be wary of investment scams. If something sounds too good to be true, it probably is. 10. Resources for beginner investors. There are many resources available to help you learn more about investing. Here are some of my favorites. Websites. Investopedia, a comprehensive online encyclopedia of financial terms and concepts. The Motley Fool provides investment advice and stock recommendations. Morningstar offers independent investment research and ratings. Yahoo Finance provides market data, news, and analysis. U.S. Securities and Exchange Commission, SEC, provides information about investing and investor protection. Books. The Intelligent Investor by Benjamin Graham, a classic guide to value investing. A Random Walk Down Wall Street by Burton Malkiel, an exploration of market efficiency and investment strategies. Online courses. Coursera offers a variety of courses on investing and finance. Udemy provides affordable courses on a wide range of topics, including investing. Khan Academy offers free educational resources on finance and economics. Financial advisors. Consider consulting a qualified financial advisor for personalized investment advice. Remember to do your own research and consult multiple sources before making any investment decisions. So there you have it, a beginner's guide to investing. I hope this video has helped to demystify the world of investing and given you the confidence to start building wealth today. Start building wealth today. Remember, investing is a journey, not a destination. Be patient, stay disciplined, and continue to learn and adapt. If you have liked what we've shared and want to support us, think about treating us to a coffee. Just visit the video description and select the Buy Me a Coffee link to give a donation. Your support enables us to create more videos, delve into different subjects, and improve your overall experience. If you found this video helpful, please give it a thumbs up, subscribe to the channel for more financial tips, and leave a comment below with any questions you have. I'd love to hear from you. Thanks for watching, and I'll see you in the next video.